what the impact is of the RBI proposing the tighter project finance rules, what the implications of these are. And we've got Anil Gupta now joining in from ICRA. Anil, thanks so much for taking the time out. Clearly seeing the implication play out on the likes of an REC, PFC. Give us a sense as to what these tighter project finance rules, what the negative implication is for companies such as this.
Sure, thank you. Good morning to all of you. So basically, the regulation which has come out is it is harmonizing the guidelines which were there for banks and NBFCs earlier. So, for example, let's say today, if a project defers its DCCO, right, and that deferment is within a period of 2 years, the standard asset provisioning norm for a bank is 0.4%, and for an NBFC it is 0.25%. Now, what this circular is saying, that even if there is a deferment of DCCO, right, within a period of 2 years, because there have been some deterioration in the project fundamentals, the standard asset provisioning should increase to 5%. So this 5% provisioning requirement, which is specified with this circular, in our view, this is applicable only for the projects who are taking a DCCO extension and not for all the projects which are under construction. Now, if this deferment is beyond 2-year period, let's say for an infra project, the earlier guidelines required a provisioning to increase to 5%, right? The new guidelines which they are proposing says that if the deferment is beyond 2 years, then additional 2.5% over and above 5%, which it is currently specifying, will kick in. So total provisioning requirement for cases or projects which are deferring DCCO by more than 2 years, the total provisioning requirement will be 7.5%. Why this is good from the strengthening of the balance sheets for the banks, because any project, let's say, which is undergoing a DCCO extension has undergone a change in the risk, right? So the increased provisioning requirement, even if the DCCO extension is up to 2 years, is a positive thing. So that is good thing. Another positive which we are seeing in the circular is that as per our understanding, the 5% provisioning which was there in the earlier guidelines for the projects who have taken a DCCO extension beyond 2 years, now the current guidelines allow that reduction in the provisioning from 5% to 2.5% and to 1% if the project commences the COD and also repays the debt to the extent of 20%. So that way, it will be a positive that if the project is able to demonstrate the repayment to the extent of 20% of the debt at the time of DCCO extension, then the lenders will be able to release the provision also from 5% to 1%. So that way, we believe that it is good, positive for the bank's riskiness, that if there is a DCCO extension, then you increase the provision. That will also force the lenders as well as the borrowers to possibly fix up a DCCO which is more realistic, so that you don't take a leeway in terms of a DCCO extension which is available, let's say, up to 2 years without additional provision. So you will fix up a more realistic DCCOs. You will be more mindful in terms of setting out a repayment schedule which will align to your cash flows, so that you don't have to basically avail a DCCO extension even though project is complete, but it is not generating good enough revenues to service the debt. So overall, we think it is a good thing from the balance sheet strengthening as well as provision release once the project is operational and repays the debt.
If I could talk about PFC, REC, the fact that they're well capitalized, do you sense that it may not actually lead to any damage on the profits and losses because their balance sheet is well capitalized?
See, in general, I will not comment on the stock specific things, but in general, as I said, that it is applicable only for the projects which are availing DCCO extension, right? So one, that the DCCO portfolio for the banks will not be very high, or the lenders will not be very high. We are not talking about entire under construction portfolio of the lenders. We are talking only on the portfolio which would have availed a DCCO extension. And we should be mindful that in the last few years, if we leave aside maybe the thermal power or the roads, which have been a long gestation projects and are more prone to a DCCO extension, the recent expansions have largely been in the renewable energy space, or let's say projects which are less prone to maybe a DCCO extension. But again, the lenders and the borrowers, they have to be mindful of setting up a DCCO, because in the current set of rules which are being proposed, the DCCO deferment will kick in a higher provisioning requirement.
So, welcome Rikin Shah of IIFL Securities. And Rikin, wanted to get in your take on the RBI guidelines. Do you believe for companies such as PFC and REC that as such they are fairly well capitalized and there won't be too much of an impact when it comes on the profit and loss, only on the capital adequacy, and that's the big concern?
Sure. So from the perspective of the infra-focused NBFCs like REC, PFC, the additional provisioning requirement will be appropriation of profit and via the creation of impairment reserve. So no impact on the ROEs and the PNL. However, we have estimated 200 to 300 basis points impact on their capital adequacy ratios. Of course, they are fairly well capitalized at the moment at 22% plus. So it's unlikely to be a big concern for them, unlike some PSU bank counterparts. However, from their perspective, what is worth flagging is that because your adjusted net worth, in our estimate, will be impacted by 8 to 12% on the day one of the rollout of this regulation. The valuation multiple you would ascribe and the target price you would arrive would also be consequently impacted because of lower adjusted net worth.
Sure. So given that the only drag is going to be largely on capital adequacy, and I'm talking specifically, Rikin, about PFC and REC, post today's decline, would you then recommend buying into the stock? So would you say wait it out, there could be some more decline in store?
I wouldn't, kind of give recommendation on any specific stocks. I would stay away from them. Would just kind of reiterate again as to our fundamental view on this. It will have impact on the capital as well as the valuation that you would be assigning, because the impact on the adjusted net worth will be to the tune of 8 to 12%. So the current stock price has largely, the stock price reaction today has largely kind of factored in this decline. So most of that should be priced in post the today's correction. And this impact that I'm talking about is on the existing portfolio, but even on a more recurring basis portfolio as well, they'll be required to have that adjustments to the net worth. So there are two aspects to it.
Okay, and finally, just give us a sense as to what the outlook is when it comes to the impairment reserves and what the overall impact could mean, Rikin, for the likes of a PFC and REC in terms of the higher provisions.
Basically, as I mentioned, currently the NBFCs are required to provide as per the ECL norms, and the standard asset provisioning is based on the PD LGD assumptions. Now, as per this new prudential norms, if finalized, it will require them to provide anywhere from 1 to 5% depending upon where the stage of the project is in terms of completion. And hence, the quantification, as I highlighted earlier, is 8 to 12% net worth impact for these guys.
And I just wanted to get in a take from you then as to what the outlook is, Anil. When it comes to this regulation in any way down the line, could that lead to lower loan growth?
No, I think first, given the market reaction, I think there could be a case where maybe more clarification can emerge that whether 5% provision requirement is on the entire under construction portfolio of the lenders. Because our reading is that it is only for the cases where the project is under construction and has sought a DCCO extension. So I think if that clarification comes, it should not be a really negative for the sector, because it's only a positive from the balance sheet perspective of the lenders that you are taking care of the risk which has gone up because of DCCO extension. So per se, if that clarification comes, it should not be any negative for the credit flow for the sector.
All right, gentlemen, thanks so much for joining in and giving us your expert take as to what exactly these norms mean for the companies. Tell you what, we'll wrap it up then on this edition of First Trades and the Market. Thanks so much for tuning in. We've got Buy Now, Sell Now lined up next.